Welcome to the deep dive. Today, we're tackling a question that's probably crossed your mind if you're trying to invest smart.
Mhm.
Are those simple tricks or, factors people talk about, do they really lead to better returns?
Yeah, it's like peeling back the layers on those popular investment ideas, the ones that kind of promise an easy way to beat the market just by following a certain rule.
Exactly. We've all heard them, right? Buy low, sell high. Or maybe more specific things like investing in small companies or stocks that are already going up.
Right.
Today, we're going to put those ideas under the microscope, really, based on some pretty deep academic research.
hmm Our main source today is a paper called Replicating Anomalies by Hu, Zhu, and Zhang. And what's really striking about it is the scale. They didn't just look at a few anomalies. They examined a huge data set, 452 of them.
Wow, 452. That's a lot of potential investment edges that people have talked about or written about. So, what did they actually do with all these supposed market secrets?
Well, they put each one through some really rigorous replication tests using, the kind of standards expected in serious financial research nowadays. They wanted to see which strategies actually held up when you really scrutinize them.
Okay, so our deep dive today is all about unpacking what they found. We want to figure out which of these investment holy grails are actually robust, and maybe even more importantly, why so many might not be as reliable as people thought.
And we'll also touch on what this means for like how efficient the market really is and maybe how you should approach investment strategies knowing this.
All right, let's get into it. The first big thing that jumps out from this study is, well, just how hard it is to get these previously reported advantages to work again when you test them properly. Replication seems tougher than it sounds in finance.
Yeah, and what's interesting is the range of ideas they looked at. It wasn't just obscure stuff. They covered well-known concepts uh, like momentum.
The idea that winning stocks keep winning.
Exactly. And value investing, buying
Hmm.
stocks that seem cheap compared to their fundamentals.
Right, and they looked at other things too, like how companies invest or how profitable they are.
Yep, investment, profitability, even things like intangibles, and also factors related to trading mechanics like liquidity, how easy it is to buy or sell a stock.
So a really broad sweep. And when they applied these tough testing methods, you said the results were surprising.
Very surprising.
Yeah.
When they ran a standard statistical test looking for significance, basically an absolute t-value over 1.96.
Which is a pretty common benchmark, right?
It is, well, a massive 65% of these 452 anomalies, they failed. They just didn't show up as statistically significant in the replication.
65%. That's almost two-thirds. So most of these supposed market-beating strategies couldn't even pass that basic test. Makes you wonder.
And it gets even more, well, stark. They used a stricter test, too, a higher threshold for significance.
And the failure rate went up.
It jumped to 82%.
82. So the vast majority. They just didn't hold up. That really does suggest, like the study says, that maybe the market is more efficient than we often give it credit for. Finding those easy wins might be really tough.
Exactly. This high failure rate kind of hints that maybe some of these discoveries were just, well, patterns found by chance in the data, what we call data mining.
Right. If you test enough things, something's bound to look good just by luck.
Precisely. And rigorous testing helps weed those out. So a key question is, what specifically about their testing led to this? And one huge factor they highlight is the influence of microcap stocks.
Microcaps.
Yeah.
These are the really tiny companies, market value-wise.
That's right. I mean, they make up a lot of the number of listed companies, maybe around 60%, according to the study. But in terms of total market value, tiny, only about 3%.
So loads of them, but they don't represent much actual market capital. How do these little guys end up messing with the anomaly results?
Well, these microcaps, they tend to have higher average returns if you weight them equally. So if you treat a tiny company's return the same as Apple's return.
Okay.
But, and this is key, they're also way more volatile. Their prices jump around a lot more than bigger companies.
Ah, okay. I can see how that might muddy the waters, maybe.
Yeah.
If an anomaly only works because of these really small, jumpy stocks.
That's exactly the issue. So what happens when you try to sort of filter out that effect?
How did they do that?
This is where their method gets interesting. They use what are called NYSE breakpoints. Basically, they focus on the size distribution of companies on the New York Stock Exchange, which tends to have larger, more established firms.
Okay, so using the NYSE as the benchmark for size?
Right. And they also use value-weighted returns. This means bigger companies have a bigger impact on the results, reflecting their actual market size.
So, focusing on the bigger, more liquid stocks and weighting them appropriately, trying to see if the anomalies work in the part of the market where most money actually is.
You got it. By doing that, they could see if an anomaly was really broad-based or if it was just being propped up by these tiny, often less liquid stocks.
And what happened when they did that?
Well, the replication rates for many anomalies just plummeted, especially, the study points out, in the trading frictions category.
Trading frictions, like liquidity and volatility stuff.
Exactly. Things like how easily a stock trades, how much its price moves around. A staggering 96% of the anomalies in that category failed to replicate once they controlled for microcaps this way.
96%. Wow, that basically wipes out that whole area. So a lot of what we thought we knew about liquidity or volatility predicting returns might have just been a microcap thing.
It really looks that way. That's a huge finding.
A real eye-opener.
And what's also fascinating is even when they used methods that actually overweight microcaps, like equal-weighted sorts.
Giving the little guys more influence.
Right. Even then, several well-known trading friction anomalies still failed. Things like probability of informed trading, liquidity beta, idiosyncratic volatility.
That's the stock-specific randomness, right?
Yeah, the movement not explained by the market. Even the high-low spread, they still didn't replicate robustly.
So even giving microcaps a boost didn't save some of these. And the study also questions if these microcap-driven effects are even useful for most investors, doesn't it?
Exactly, that's a crucial point. Even if you find something statistically significant because of microcaps, can you actually invest in it meaningfully?
Because the companies are so small.
Yeah, the amount of money you can put into these tiny stocks is very limited. Trying to invest a large sum would likely move the price against you, potentially erasing the very anomaly you're trying to capture. So the economic significance is questionable for, say, large funds.
Right. The potential payoff might just be theoretical for many people. Okay, so moving beyond microcaps, the study also looked at replication across different types of anomalies, right? And it wasn't all good news there either.
No, definitely
Okay.
not. The paper lists quite a few well-known, influential anomalies that just didn't hold up under their stricter tests.
Like what? Give us some examples.
Okay, so in a value versus growth area, things like betting against companies with high 5-year sales growth or relying on negative long-term analyst forecasts, those failed. Strategies based on financial distress scores like the O-score or Z-score also failed. And even Piotrowski's F-score, which is pretty widely used by value investors to find fundamentally strong stocks.
That didn't replicate strongly either.
Not according to their rigorous standards, no.
Wow. Okay, those are some big names in the value world. What about other categories?
Well, in profitability, even the operating profitability factor that FOMA and French highlighted in their big 2015 paper,
Yeah.
that didn't replicate strongly. Same for total accruals in the investment category.
Accruals, like non-cash earnings.
Sort of, yeah. Measures related to that.
Mhm.
And even things like corporate governance, indices, scoring companies based on board structure, shareholder rights. Those didn't hold up well either.
So it's not just one area, it's across different types of strategies. And it wasn't always that they completely vanished, right? Sometimes they just looked weaker.
That's a key point. Even for anomalies that did manage to replicate and show some statistical significance, the economic magnitude, the actual size of the expected return, was often way smaller than what the original studies claimed.
So the potential edge is much smaller in reality.
Exactly. They mention examples like price momentum, cash flow to price, operating accruals again, earnings momentum, customer momentum, asset growth. These might still wiggle a bit in the data, but the potential profit looks much, much less impressive than originally advertised.
The shine definitely seems to have come off many of these. Okay, let's talk about the methods they used. It sounds like they were pretty thorough.
Oh, absolutely.
Yeah.
Very rigorous. They really tried to follow the original definitions from the first studies that reported these anomalies. They even tweaked things slightly sometimes just to check. And for monthly effects, they looked at different holding periods too.
Because some effects might fade quickly.
Right. And crucially, they tackled that issue of multiple testing we mentioned earlier.
Refresh my memory, why is that so important when you're looking at 452 different ideas?
Well, when you test that many hypotheses, you're almost guaranteed to find some that look statistically significant just by pure random chance. It's like flipping a coin 452 times, you'll get some weird streaks that look meaningful but aren't.
Right, false positives, things that look real but are just noise.
Exactly. Multiple testing adjustments are statistical tools to correct for that increased risk of false positives when you run so many tests.
Okay. And when they applied these adjustments,
The number of anomalies that still look significant dropped even further.
mm,
They used stricter t-value cutoffs like 2.78 and even 3.39, which demand much stronger evidence.
and fewer anomalies made the cut.
Significantly fewer. This really strengthens the argument that maybe a lot of the initial discoveries were just statistical flukes, not real, repeatable market effects.
Now, you mentioned earlier that using their preferred method NYSE breakpoints and value weighting to control for microcaps actually resulted in lower replication rates compared to methods that give microcaps more weight. That still feels a bit odd.
It highlights the dilemma, doesn't it? Yes, you can sometimes make an anomaly reappear statistically by emphasizing microcaps, using equal weighting or broader breakpoints.
Right.
But the economic relevance, the practicality for actual investors, remains a huge question mark for those microcap-driven effects. And even with those methods that helped microcaps, the failure rate was still really high once they accounted for multiple testing.
So, whichever way you slice it, a large chunk of these anomalies seem shaky at best. Did the study break down failure rates by category? You mentioned trading frictions were bad.
Yeah, trading frictions were definitely the worst. Almost everything failed there once microcaps were controlled. Volatility measures, liquidity measures, they largely vanished. And short-term reversal, the idea that recent losers bounce back quickly,
Yeah.
that seems to be mostly a microcap story too, according to this study.
Interesting. I feel like you hear about short-term reversal more broadly.
Well, this research suggests you should be cautious about that, unless you're specifically playing in the microcap space. Intangibles also had pretty low replication rates.
Things like R&D, brand value.
Mm-hmm. Maybe because they're just harder to measure consistently,
Yeah.
making the anomalies less stable.
What about the classics? Momentum, value versus growth, investment, profitability. How did they fare overall?
They did a bit better than trading frictions and intangibles, but still, far from perfect. Overweighting microcaps seemed to revive some effects in these categories more easily than in the others.
Can you give specific examples within those? Like, how did standard momentum or value factors hold up?
Sure, for momentum, things like earnings surprise momentum, betting on positive earnings, surprises that lost quite a bit of significance after controlling for microcaps. Even standard price momentum, while still there, seemed weaker than in older studies.
And value. We mentioned Piotrowski and the distress scores failing.
Right, and other value factors like low 5-year sales growth or negative analyst forecasts also didn't replicate well under their stricter approach.
What about investment and profitability factors? Any specific hits there?
Yeah, things like investment to assets or operating accruals, they showed much smaller effects than originally claimed, and again, microcap weighting seemed to inflate the results. For profitability, return on equity showed some significance, but short-lived. Piotrowski's score failed. The distress anomaly failed.
Distress anomaly, like betting on nearly bankrupt companies.
Essentially, yeah. And interestingly, they found the gross profitability premium, which has been popular lately, might actually be mixed up with the investment factor. Once you account for investment properly, the profitability effect shrinks quite a bit.
Okay, so it really feels like the message across the board is caution. A lot of these seemingly simple rules are less reliable than we might think. What are the big picture implications here for investors?
Well, the biggest one is probably that consistently beating the market just by applying these well-known anomaly factors, it looks much, much harder than many believed. The high failure rate, especially after dealing with microcaps and multiple testing, really supports the idea that markets are pretty efficient.
Finding those easy edges is tough.
Very tough. It suggests those simple formulas might not be the answer.
So the markets may be a harder game to win consistently than some strategies imply.
That seems to be the takeaway. And while the study notes that microcaps might not be directly investable for large players due to costs and capacity,
Right.
they do point out these small firms are still really important for the real economy. Jobs, growth, innovation. So understanding them matters, even if it doesn't translate directly into an easy investment edge for everyone.
Okay, so let's try and wrap this up. Our deep dive into replicating anomalies seems to show that, well, a whole lot of investment secrets kind of dissolve when you look closer. Rigorous testing, accounting for tiny company effects, dealing with statistical chance. It takes a toll.
It really does.
Yep.
And that finding about trading frictions was particularly stark, wasn't it?
Sure.
96% failure rate after controlling for microcaps. That really challenges common wisdom about liquidity and volatility.
Yeah, definitely. So for you, the listener, the main message here seems to be Approach strategies based on these simple published anomalies with a healthy dose of skepticism, just because a pattern showed up in the past.
Doesn't mean it's real or will continue.
Exactly. Understanding how microcaps can skew things and how easy it is to find statistical flukes when you test hundreds of ideas. That seems crucial for making smarter decisions and maybe not chasing every new factor that comes along.
Which leads to a bigger, maybe more provocative thought to mull over. If so many of these famous anomalies seem less powerful than advertised, what really drives long-term investment success? Maybe the focus shouldn't be on finding the next magic formula.
But on something else.
Perhaps on more fundamental principles. Things like understanding and managing risk properly, having a solid grasp of valuation, appreciating market efficiency. This study kind of nudges us away from chasing patterns and maybe towards a deeper, more disciplined approach to investing.